Welcome to Edison TV. I'm Marvarine Cole, and today we're discussing Condor Gold plc with the chairman, Mark Child. Mark, thanks very much for joining me. Can you tell me first of all more about Condor Gold plc and where it operates?
Yes, Condor Gold is an AIM-listed gold and silver exploration company. It's been operating in Nicaragua and El Salvador for the last 7 years. Our focus is on La India project in Nicaragua.
What's your key strategy over the next 6 to 12 months?
Having completed a preliminary economic assessment in March of this year, the next step for us is the pre-feasibility study. And in order to achieve that, we have to put in about 20 to 25,000 metres of drilling. We have to convert inferred resources into indicated resources. And the particular focus from us is proving additional open pit ounces. So our open pit resource is 950,000 ounces at 3.6, of which 550 is in the indicated category, the higher level of confidence at 4 grams. We would target by October, November to increase the indicated open pit resource to between 1.1 and 1.3 million ounces of gold. And we need to have that sort of number of indicated and open pittable ounces before we go into the pre-feasibility study. So that's the key plank. The second part is we're conducting all the mining studies required to drag this through to a producing mine and a bankable feasibility study. That involves metallurgical tests, hydrology tests, geotechnical drilling, environmental impact assessments.
You have £8 million in cash. So will that be enough to cover a pre-feasibility study, and how much exploration will that cash actually cover?
It'll cover 20 to 30,000 metres of exploration. We also have to do the various studies which I mentioned, the metallurgical, geophysics, environmental impact studies. We have 5 drill rigs turning at the moment, and we're trying to increase the size of resource, open pittable resource, from 1.1 to 1.3 million ounces. There should be enough cash there to see us through to PFS, but we're still trying to size the ounces of gold of open pittable nature to go into the PFS. The idea being that rather than the current PEA, where we have 50% of the production open pit and 50% underground, it would be better to move all the production into open pit production for the first 4 years, because that would mean that the capex required for underground would be removed, and that could be a saving of $40 to $50 million for us, so that's quite important. Then if we can pay the loans off via open pit production, we can then use the cash flow from open pit production to go underground at a later stage.
How do you rate the Nicaraguan authorities in helping move forward on production and also possible participation demands?
Nicaragua is incredibly mining friendly. There are 3 producing mines in the country, all owned by foreigners. We own 100% of our concessions. Gold is the second biggest export in the last quarter, and they realise that gold exports and production are a very important part of alleviating poverty in the country. It is the second poorest country in the Western Hemisphere after Haiti. So they've been terribly encouraging. We have the biggest resource in the country with 2.5 million ounces of gold, and they'd like to see us put that in production as quick as possible.
Can you explain the advantages of open pit operations over underground, and what proportions of resources do you expect to mine through open pit methods?
The preliminary economic assessment, which was out in March this year, details 150,000 ounce production per annum for the first 8 years of a 13-year mine life. Over the life of mine, the production is split roughly evenly between open pit and underground resources. The difference between the two is that the open pit production is a lot cheaper to put into production because you haven't got to do underground development work. Each time we go underground with a shaft or a decline, it costs in the region of 15 to 20 million US dollars of capex. So it's people much prefer to start off with open pit production. In terms of capital costs, the second reason is that the operating costs tend to be a lot lower. You're $2.20 US moving per tonne of earth in open pit in Nicaragua, as opposed to $50 per tonne moving it from underground. So there are both operational savings going open pit and capex reductions.
Mark Child, Chairman of Condor Gold plc, thank you very much indeed.
That's my pleasure.